Hey, so Brian, obviously, rates. We talk about it all the time. Rates going up, a lot of volatility in the market, and watching some of your videos a lot, and obviously you're very educated on how rates work. You talk about the 10-year Treasury, and I think a lot of people don't understand how that works and how that regulates rates. Can you share a little bit why the 10-year Treasury is kind of one of our barometers that we look at on a daily basis, because it kind of tells us which way rates are going?
So the 10-year Treasury is just a benchmark that we look at. It doesn't mean, so most of the time, really what we have is what's called the mortgage-backed securities. It's actually the MBS, and that's what we track. But the MBS and the 10-year note, most of the time, not in all cases, kind of run together. They go up together, they come down together, they go up together. And I'm just going to go to my phone live right here. And when I go to my phone live right here and I pull up the bond market, I can see right here, CNBC, everybody can see this. When it's red, which is this button right here, that tells us that the bonds are actually dropping in cost, okay? And what does that do? That affects most of the time when it's going down. That's what we want. When it's green, green's great if you own Apple. Green's great if you own Microsoft or Meta or SpaceX. Green means it's going up. Red means it's going down. And if you just take a look at what's happening right here, this is a 5-day chart. Here, up, up, up. And now it's dropped down substantially. So that's because the Strait of Hormuz is there, and all of a sudden ships are flowing. Oil is at $70 a barrel. We're on 100-ish. But most of the time you want that to go down. We want that to be down into the threes. So just before the war, we hit about 3.9 on the 10-year note, and our mortgage rates were down in the fives. So, it's...
So say on the, just so I understand and everyone understands, on the 10-year Treasury, right now it's right around
4.402.
So how does that, okay, so say 4.402, how does that equate to rate, and how investors price their rate?
So that's kind of the mortgage-backed security is the true trigger for us, but on average, you could almost say there's about a 2-point margin that the window's giving the money out at, and then what it's actually getting to. So if we're at 4.42, you're probably seeing a 30-year fix starting to approach 6.4. Now you got to remember, if you look at the Fannie Mae, who will show every week they do this, they show what was delivered. They're not quoting rates, they're quoting what was delivered across the country. And last week, they quoted, I taught this in my class yesterday, but last week the average rate was like 6.52 that was delivered to Freddie Mac for the whole week, and every week they update. And it was higher the week before, and it was higher the week before. But what that doesn't tell is the whole story. It doesn't tell you what the average interest rate was. It doesn't tell you what the average credit score was. So you could have somebody that might have been at 7.25 because they had a 622 or 640 FICO, or was putting down just 5%. And they have some people in there that were putting down 40% and buying 2 points in their interest rate. So the average was in that 6.5-ish range. So as you see that 10-year go down, usually the mortgage-backed securities will follow it, and then our customers will start to see the market improve. If this trend continues, before the war started, we were down at 3.9. We haven't touched 3.9 for a year and a half. So if we go down to 3.9, you'll continue to see better and better improvement on the market. The rates will continue to trend down. We were already at 3.99. We've got a new aggressive Fed chair that also wants to be able to see rates. So inflation came out today. That was doing on track. We're moving into a place where I think things will be better in the next 3, 6, 9 months. So if you purchase now and this is where you are, don't worry. 6, 7, 8 months, I think it'll be better. We'll refi, we'll get you down.
So one other question on that. Now, is there like a nothing set, but like a margin between the 10-year Treasury current rate versus where rates are? Like, obviously they're going to be higher. Is it usually higher by 2%, or is there not? Is that
so the Treasury might move and the mortgage back doesn't, but on average you're probably looking at a margin of about 2.25, meaning that if it's at 4, you're not going to get the rates at 4. There's a margin in there. Every bank, Bank of America, City Chase, they all need to make money on it. There's a process to employ 10,000 people at Bank of America, and the loan processors and the underwriters, the computers, the heat, the AC, all of that stuff. So it costs money. So there's typically about a 2.25 point margin on there. So if you're at 4%, you're going to be around 6.25. And it's, again, we're following the 10-year, and it's really the mortgage-backed security. One of the things that our new Fed chair is doing is he's injecting money into the market. He's creating false buyers for a market, which is allowing us to get more liquid on it, and that's also going to help bring the rates down.
And one other piece, and something we run into all the time, when the Fed cuts rates or raises rates, we always the phone rings when the Fed does cut rates. That doesn't directly impact our mortgage rates. Why is that?
So when the Fed cuts rates, so if we look at the last 6 times they cut rates, it had an adverse effect on the market. A lot of times it's the language that the Fed chair talks about. Sometimes it's already priced in. Everybody already had, hey, you know, the voters was 70% chance they were going to cut a quarter or cut a half, and then either it gets the demand of what's expected or it didn't. But then he says something that the market gets nervous about. If they cut rates, things that it does affect, it usually affects car loans the following month when banks are lending money. It also will affect if you're at a reset and you're on an adjustable rate mortgage and that 1 year goes by and you're going to go back to the current market plus a margin. They're going to take a snapshot in time on whatever indice it follows, and that snapshot will have a margin built into it, and you sign the paperwork saying it's going to be a 1% over the LIBOR 5-year, 1 year ARM, whatever it is, and that's what they're going to follow. So that snapshot could make your mortgage, if it's an equity line of credit and it's not fixed, you could see something like that go down. But your traditional 30-year fixed, we want it to go down. Unfortunately, depending on if the market was counting on a half or a quarter or something, the Fed, it can turn things. All 6 times that they cut, the last time rates went up. But then it starts to settle back down. And then it has a lot to do with the numbers that are reported, whether the consumer price index is going up or down, if inflation's going up and down, if we're seeing housing costs or gas costs, all of those things. Gas is one of the key things and a factor. It costs me more to heat my house, costs me more to get the goods to the shelves. All of that affects inflation, and we want these things to trend down. Oil back down to $70 a barrel, I think it said. That's good for us. So I do think the market right now, as long as nothing changes drastically over in the Iran area, I think we'll continue to trend down. The oil will probably hit 65-ish a barrel and stick in that area. The 10-year note, mark my words, it'll drop down to 3.9. We will get there. It could take a little more time, but it's coming.
Where's Bedford get their gas? Because I leave Auburn in the morning and my gas is at $3.79 a gallon, and when I drive to the office down here, your little mobile is at $4.40. So I'm just wondering why that's going on.
Yeah,
in
well,
Bedford is Bedford.
They only have 2 gas stations in the whole town. I'm up for saving $1 or $2, so I'll drive to market. I'll go get gas up in Auburn. I don't care. I'll save $1.
I would. So. Auburn's a blue town. That's why our gas is where it's at.
I'm not getting into towns. Not getting into colors. So appreciate you guys. Thanks for tuning in.
Yeah.